Have you seen silver? Look at that huge run. Silver is out of control. But listen, not every trade that you put on is going to look like this. Some trades are going to be great, big, giant winners, and some are just not going to work at all. And that's okay. When it comes to trading, you don't have to have a 100% win rate, a 90% win rate, an 80% win rate. You really don't. What you have to do is cut your losers short and let your winners run out of control like this. And that pays for all those losers combined. Today, we're going to watch this video called The Hidden Rule Behind Legendary Trading Systems, and it's not the win rate, which is probably going to blow a lot of people's mind. But let's watch this together. And by the way, I am a professional investor. I am competing in the US Investing Championship, and linked down below for absolutely no cost whatsoever is my spreadsheet for every single trade that I've taken this year while I'm competing in the US Investing Championship, and my full trading plan. Link down below, no cost whatsoever, free for you. Let's go.
The most successful traders are designed to fail, repeatedly. Minervini.
Okay, we're starting out hard. The most successful traders are designed to fail. Minervini, this is one of my mentors. And guess what? He has won the US Investing Championship twice. And guess what again? I am going to be interviewing him live on this channel. So be sure you subscribe. I don't want you to miss out when we're interviewing two-time US Investing Championship Mark Minervini, personal friend of mine. I'm very excited about that, in fact. Let's keep going.
Minervini, Kalamagi, and Davis all accept frequent small losses at the cost of finding rare, outsized winners. Their systems expect failure, and they profit because of it.
Okay, so before we get too deep into this, let's rationally think about this, right? In our trading plan, in fact, I'm going to make this bigger again. In our trading plan, Plan M, our most aggressive trading plan, has this backtesting data to support it. Okay, there's no trust me bros at OVTLYR. Everything is all database. We have a team of over 20 PhDs, actuaries, rocket scientists, math nerds with one goal, and that's to help you save time, make money, and start winning with less risk. Okay, now look at this. Even with our best plans put together, has a 56.94% win rate. Well, that's not very good, Chris. You're so stupid. Don't you understand that you got to have a 100% win rate, or I mean, at the least a 90% win rate to be successful in the markets? If you're anything less than that, you're just a moron. Sure, by all means, you go find that plan for me. And when you reach the yellow brick road, tell the Wizard of Oz I said hi. Now, looking at this, right, we are building into the system losses. If you don't build into the system losses, you will not be successful. Period, full stop. It's never going to happen. Now, what matters is your expectancy. Your expectancy is the calculation of your average win percent or dollars times your win rate. And then you subtract out your average loss percent or loss dollars times your loss rate. When you subtract your loss rate from your win rate, basically, you get your expectancy. Now, this is what matters at the end of the day, but you won't get this unless you have a high frequency. So for example, right now we're 9 trades deep in the US Investing Championship with a 100% win rate. Now, is that going to stay 100% forever? No. I wish I could tell you the fact of that, but no, it's not going to happen. By the way, these are my results so far for this year before today's open. Of the 100% win rate. I know that that's not going to stay there. Okay. A lot of people, though, they're like, oh my gosh, this is the greatest thing ever. I'm just going to win, 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 win. No. I think you need to understand we are going to lose at some point, but the losses are going to be smaller on average than the win rate. And then when you combine the fact that we have a greater than 50% win rate, or win percent, I should say, we have a greater than 50% win rate. This is actually Masters of the Universe money. This is what Masters of the Universe money looks like. It may not sound like much, but once you understand the data behind why we trade the way we trade, and this is not just me, this is what successful investors do. Successful investors understand their wins, losses, and expectancy. So let's continue on here.
Many traders chase a high win rate, believing that winning more equals more profit. The problem with this theory is that it only takes one loser to wipe out those gains.
That exact thing happened to me. So for years, I traded iron condors. I would sell options. I'd sell calls. I'd sell puts. I'd sell call spreads. I'd sell put spreads. And I had an 84% win rate. I kid you not. My actual returns were an 84% win rate. Guess how much money I made? Guess how much money I made? Negative $200,000 with an 84% win rate. Then I thought, you know what? There are people who have made money in the markets. I need to go figure out who they are. That is how I connected with Steve Burns, who was the greatest mentor of my entire life. People like Mark Minervini. I've worked with 5 different market wizards, including Minervini. And I'll never forget the day Minervini said, Chris, this is why your trades suck. And like, it hit me right in the core. He also told me to shut up and listen to people who have been making money in the markets for real. Same goes to you. If you think you're smarter than the market, just wait. You need to shut up and listen to people who have actually made money. Let's keep going.
Often leading to a losing account overall. Let's compare both models. On one side, you have trader A targeting a 90% win rate, and on the other
That was me.
side, trader B targeting a 30% win rate.
Wasn't me, still isn't me. I don't want a 30% win rate, but you can be unbelievably successful, significantly more profitable than this trader with a 90% win rate.
Trader A requires frequent winners, often requiring looser risk management to do so. They take profits quickly and allow more room before a loss to be confirmed. This leads to an asymmetrical risk profile of big losses and small rewards, effectively building a system demanding loss avoidance. Trader B, however, has built a system using the opposite concept. They allow less tolerance for a loss to be confirmed, whilst allowing more room for a winning trade to be confirmed.
Remember, cut your losses small and let your losers run out of control. This is why I really like reinforcing the point of winning is an inevitable part of trading. It is inevitable and unavoidable to win, but it is also inevitable and unavoidable to lose. Once you embrace that, once you understand that you can lose plenty of times and still be unbelievably profitable, then you will find success in the markets.
This is referred to as asymmetrical reward, small losses and large rewards, effectively building a system of loss allowance.
I'm seeing O3s and G3s coming through. Let's put that O3. Well, he didn't say that. I said that, but I'll give it to you in G3.
Trader A can only afford to be wrong once in every 10 trades, whereas Trader B can afford to be wrong 7 times in every 10 trades, therefore building failure into the system. Psychologically, it's far easier to stay disciplined knowing that you can be wrong far more times than you are right on any given trade, whereas knowing you can't afford to be wrong will be far more draining.
Yes, and this was me, right? Whenever I had a loss, it was a 6, 8, 10, 12x the size of my wins. So think about that logically. It would take me 6, 8, 10, 12 trades in a row, perfectly traded, to make up for the one large loss. On the other hand, if your large win is 6, 8, 10, 12 times the size of your losses, who gives a flying flip? Just get out of the trade and move on. Just get out of the trade and move on. I will give you guys consistency and discipline. I'm seeing B4 come through. Manny is always running the show when it comes to bingo. But he did say discipline. I got you. Okay, let's keep going.
The large risk, small reward problem applied by many traders is largely driven by human psychology. The need to be right pushes traders to take profits too early, using quick wins as validation. Conversely, excessive risk-taking often comes from an aversion to being wrong, leading traders to hold losing positions rather than accept a loss.
And in fact, the people that I learned to trade from originally told me and the people that they would teach, it was all theory. It was 100% theory. I'm not going to drop names. You guys have heard me drop names before, but I'm not doing that today. It was 100% theory. It was, oh, you got to sell options all the time. So you sell calls when the price goes up because it's going to go back down. Sell puts when the price goes down because it's going to go back up. When in theory, that is actually asking for your account to get blown up. The efficient market theory is real. Markets will trend much farther than you could ever imagine them because it is a virtuous cycle. It is people buy the stock, pushes the price up, which gets more people excited. So they buy the stock, which pushes the price up, which gets more people excited. It is a virtuous cycle, right? Markets are not efficient because in efficient market theory, they can't do that. An efficient market theory says that everybody is logical, nobody is irrational, fear and greed is not existent, and everybody will make the exact same most rational, bestish choices for them. Right. Then price will always be at 100 and never change. Right. So that's just not the case. Okay. But the people that I learned from, they fully believed in the efficient market theory. And one thing that they would tell you, which absolutely is the worst financial advice you could possibly get, is if it's not working for you, now this is going to be a little confusing for those who roll, just roll it out into the future. Meaning, take a debit, move on, or maybe even take a credit, move on. Just hold it. Eventually, it'll come back. Eventually, it'll come back. And when it does, you will be set, right? Eventually, when it comes back to the price you need it to be to win, you'll be set. But don't worry. Don't worry. Trends don't exist. You won't be sitting on that trade for the next 6 months, 8 months, 2 years, maybe even longer, rolling and rolling and rolling, tying up capital. It's a terrible trade, but yet we're just going to keep rolling it because the markets are efficient. They have to come back, right? Right? No, don't ever believe that. Don't ever believe that. You want to be riding the wave up. You want to be all up in the stage 2 uptrend, right? Everybody feels like a genius in a bull market. It's a fact, okay? And a lot of our traders right now, the outliers who have had fantastic returns so far this year, are feeling like geniuses. But remember, geniuses, you're going to end up losing at some point. Are you mentally ready to take those losses? I actually don't like seeing this type of win rate in my account because I think it lulls people into a sense of complacency, right? If I'm up 44% on the year with a 100% win rate, that lulls people into a sense of complacency, thinking, oh, this is just how it's going to be. But it's going to turn around. It's not going to be great when it does, but how are you prepared for it? That's the real question here. Let's keep going.
Our video library covers many traders who apply this low risk to reward concept, such as Mark Minervini, Nicholas Davis, and Christian Kalamagi. Neither of them tried to be right often, they simply tried to be right bigger. A system with failure built in assumes you'll be wrong most of the time, but will still make money.
So when we were working on the Plan M last summer, I was working with Scott. We were talking about, or one of the things that he and I would talk about, man, I would wake up at 3 a.m. with ideas, right? I would text him, and he lives in England, so that was like 9 a.m. his time, so that's fine. But I'd wake up at 3 in the morning and be like, hey, did we test this? Hey, did we do that? And my whole process, and I told Scott this over and over and over, is we must make the plan robust. Robust in terms of trading means that you can withstand losses, no issue. No issue. Any market condition, you can make money. That is what a robust plan is. A overfitted plan, which is easy to do, really easy to do. An overfitted plan is where you say, okay, on Tuesdays, on leap years, on when that Tuesday lines up on February 29th, it always works. And you may have the data to back it up. Every Tuesday on a leap year on February 29th, that it works. And there may be 3 instances of that, right? But every time it works, it works. It's like Sex Panther from Anchorman. 60% of the time, it works every time. Or you can say, I don't know what's going to happen, but I'm going to build a plan that's robust so that whatever's happening out in the marketplace, I'll be there for it.
We look at some real data using this concept. Let's look at how the maths works in theory. Imagine your trading style provides a 30% win rate, meaning you achieve 3 winning trades out of every 10 placed. If we assume each of the losing trades has a value of 1R, but each of the 3 winning trades achieve 5 multiples of risk, we can calculate the total returns. The 7 losing trades equate to negative 7R, whilst the 3 winning trades total a positive 15R,
Which is pretty sick, right? Your 7 losing trades are like half of what your winning trades are. Now, guess what R represents in our style of trading? Anybody in the chat? I want you to put it in. How much does R represent in our style of trading? Go. That's how the maths work. Masters of the universe money. That's a good answer, but not the answer I'm looking for. What does R represent in our trading? Not necessarily 4%. Not 0.01. ATR. Boom. ATR. That's what it represents. Now, one of my all-time favorite trading books is called The Complete Turtle Trader. You can find that everywhere. It costs you like $8 or whatever. This is one of my top 5 favorite trading books. In there, they talk about the letter N representing their risk. What does N represent? Also ATR, right? ATR is a very valuable tool in your toolkit, but most people have no idea what that is. Most people have absolutely no idea what ATR is or how to represent risk like that. Let's keep going. Hey, there's Cam. I'm meeting with Cam later today. What's up, Cam?
Getting a total 8R over the 10 trades. Therefore, if 1R equaled $100, your total profit would have been $800 despite losing 7 trades. It reinforces the common quote, cut your losers short and let your winners run.
Did he actually say what Chris says? Cut your losers short and let your winners run. Wow. What a trite, cliche thing to say. However, it's the truth.
Now let's look at the 90% win rate approach. Such a high win rate requires that you win 9 out of 10 trades, which almost always requires a higher risk allowance, thereby allowing for trades to recover before capturing a profit. Using R multiples once again, let's assume that the risk tolerated for any one trade is 9R, whilst also assuming that the winning trade equates to 1R. After 9 winning trades from 10 and 1 sole large losing trade.
Monty Friel says we have a double G3. You know what, Monty? Just for you, because Monty and I were kindred spirits, I'll give you, since we already got G3, what am I going to give you? I'll give you follow the trend, because there's no possible way that you're letting your winners run and cutting your losses short. If you're bucking the trend, there you go. Follow the trend. I got you, Monty.
We can calculate that the strategy did not make any profit, and if just one further trade lost, the strategy could easily slip into a significant loss.
Now, this results in expectancy. Let's talk about expectancy. I mentioned it earlier, but let's actually calculate this out. All right, let's do the calculations here. So let's say that our win rate was 90%. Let's say that our average win was $1, okay? Let's say that our loss rate was 10%, but our average loss was $9. Okay, this should break even, right? So the way that we do it, formula, equals your average win times your win rate, okay? You subtract your average loss times your loss rate. That should result in 0. Yes, perfect. Now, let's say that we changed up the rules a little bit. Let's say we had a 30% win rate, okay? I need to do this. Oh, wait a minute. I need to do 1 minus this. There we go. Ooh, that looks terrible. Yeah, of course. If your win rate's 30 and your average win is still 1 and your average loss is still 9, yeah, of course that's going to look terrible. Funny part about that, that's the way most people trade. That's the way most people trade. They can't win to save their lives. Every time they see a tiny win on the board, they grab it because they're terrified of losing it. And then every time they have a loss, they just let it run out of control. This is why 90% of people blow up 90% of their accounts the first 90 days of trading. It is a fact. But let's move this around, right? So he said the average win here would be 5 and average risk is 1. So if we say average win of 5, average loss of 1, wow, that's positive expectancy. Is it huge? No. And you don't need huge. All you need is an edge, whatever that edge is, right? Think of it this way. If you were going to flip a coin, right? You flip a coin, 50-50 heads or tails. You win $2 on, no. Let's make it even tighter. Let's say you win $1.10 every time it lands on heads. Every time it lands on tails, you lose $1. How many times would you flip that coin? Well, the first couple times they were all losers. Man, I'm down $3. Ugh. But imagine you did it 300 times, 3,000 times, 3 million times, infinity times. Yeah, Charlotte's exactly right. You do it as many times as you possibly can, infinite times, as often as possible, because that is where the money is. That is your edge. That is your edge. Okay, that is your expectancy. Oh, so let's look at that, right? Let's say that our win rate is 50%. Our average win is 1.10. Our average loss is 1. That is an edge. Now you mathematically, conceptually understand why you would flip this a million times, right? Equals this times 1, 1, 2, 3, 1, 2, 3. Right? That's $50,000. $50,000 when all you win is 10 cents at a time. Okay, but let's back it up a little bit. Let's say that your average win, or no. Let's make this even better. Let's run Plan M's expectancy on here. Now you'll understand what Masters of the Universe money looks like. And remember, this is all determinant on frequency. And let's add this in. Frequency. Okay. If frequency is 1,000,000 times. Wrong way. Okay. If frequency is 1,000,000 times, that leads you to what's called outcome. Outcome is your edge times frequency. So let's put this here, edge, and let's put expectancy, edge / expectancy. It's going to be called both ways, just so you know. Your outcome is this, okay? But if I only flip it twice or 3 times, let's say 3 times, I only made 15 cents. God, this trading plan sucks. I only made 15 cents. Okay, sure, right? Because anything can happen in 3 trades. How many times have you flipped coins and 3 times in a row it lands on heads? You're like, no, it's not possible. It's super possible, right? It could actually happen hundreds of times in a row. But the more you flip it, the closer you get to your edge, okay? Now, let's take the plan M edge, plan M expectancy, and put that in here. The expectancy is 2.25%. So let's do it like this. Let's say that our average win is 7.27. Average win 7.27. Okay. And the win rate is 56.94. All right. So our loss rate is this. In fact, let's add a couple extra decimal points here. Our average loss is 4.41. 4.41. There you go. So your edge, your expectancy is 2.24. That's how this number exists. 2.25. You want to round it. All right, let's do that. 2.24, 2.25. Now the frequency here, hey, out of 3, that's actually pretty great. Now imagine doing that 100 times over the course of a year, right? $224 when you're talking about $7 and $4. But right, we're not talking about $7 or $4 here. We're talking about Masters of the Universe money. So let's say that our average win is 7,270, right? $7,220 on average win. And let's say that our average loss was also bigly, right? So let's say it's $4,410. Oh, wait a minute. Wait a minute here. That changes things, right? This is what it's like when you have an edge. And then you can take that edge and you can throw it in a Monte Carlo simulator, which we don't have to do that right now. But this is how an edge is calculated, okay? Your win rate times your average win, then your loss rate times your average loss. You subtract the 2 from each other, that gives you your edge. Now you multiply your edge times your frequency, and that gives you your outcome. Boom. Look at that. You're smarter for having watched this video. I'm super proud of yourself. Put a thumbs up emoji in the chat. Not on the see, I got one on my stream deck over here. Boom. Yes. That was cool. Put a thumbs up emoji in the chat if this is making sense to you. All right, cool. Let's keep going.
Can you see that it's the risk management of any given trade that often determines the win rate? If you ever see anyone touting such a high win rate, it's often because there is a huge hidden risk within it. If there are 2 key takeaways before we move on, it's that win rate doesn't matter and payoff does, and a system that can't tolerate being wrong is a system waiting to break. The success of a system is determined by the risk relative to reward, in combination with the win rate achieved. As your reward gets bigger relative...
Sorry, I didn't pull the bingo card. My bad. I'll give you another square just because I was taking my sweet time enjoying that video. All right, what square am I going to give you? How about let's wait in cash. Let's wait in cash. Because when there's nothing to do, you want to wait in cash so you don't blow up your account.
Relative to your risk, the win rate you need collapses, and this is how you build failure into the system. A system that is built to achieve a higher multiple of...
Okay. So this is your coin flip. 50-50. If you make a buck or lose a buck, 50-50 win rate is all you need to break even, right? If you make $5 and lose a buck, you only need a 16% win rate. That changes things, doesn't it? Pretty cool, right?
Of risk does not demand accuracy. It's far more tolerant to error, whilst the psychological burden is far less, thus allowing for the adherence of discipline. The reverse is...
Charlotte, this is actually a really key point right here. Now I see why I'm not going to make the big bucks if I don't execute every time my plan says to execute. Yes, That's something Larry Height talked to me about. Listen, I tell the same stories over and over and over because people don't listen. It's the truth. But Larry Height and we had this conversation. Larry Height was the very first $1 billion hedge fund manager, one of my mentors. He said, if you've built up your trading plan and you don't follow it, just take it, wad it up, throw it out the window. Those were his words, because you never had a plan to begin with, right? If you panic sell, if you FOMO buy into anything, if you do anything that deviates from the plan that had got you the edge in the first place, right? You did all this work to create that edge, that expectancy, and then you emotionally did something that did not fall into this, because when you made this plan, there were no emotions involved, hopefully. Then you don't have a plan. Yeah, well said, Charlotte.
This is true for a lower reward to risk. You need to be right more often, there is less room for error, and the psychological impact of needing to be right will be harder to endure. Let's now take a look at some real results with these concepts in mind. We use the same concept in our group, and the reward is almost 3.5 multiples of risk with a near 50% win rate. The equity curve can be seen here, with one important observation. No matter how good your metrics are, there will always be periods of under and outperformance. The key is to ensure you have positive expectancy and enough discipline to allow the law of large numbers to materialize.
Like, this guy knows what he's talking about, right? Now, you can't do that unless you follow your plan. You won't be able to do this unless you follow your plan. And you got to wait for confirmation of your plan in order to make it happen. And there's certainly no possible way that you're watching anything like this happen if you buy the dip, right? Because remember, you don't want to buy the dip because you don't know how far the dip is going to dip. Now, that's going to break a lot of people's mind. What do you mean you don't buy the dip? No. Chris James would buy the dip, but smart investors like you, they would not. You buy the rip because you don't know how high it can rip, right? You don't buy the dip because you don't know how far it can dip. You buy the rip because you don't know how high it can rip. There you go. What's I3? Follow your plan. I already got it. I love it when a plan comes together too. And because Fat Daddy's here with his skinny, beautiful wife, I'll give you mindset. There you go. All thanks to Fat Daddy.
The question will always be, how do we find a system of positive expectancy? And this is the quest of millions across the globe.
Man, this is cool, right? Talking about expectancy, right? With the math behind it and everything, and actually having a trading plan that a random guy on the internet executes every single day, right? Looking at so this is plan ETF, what that looks like, right? Versus plan M, right? Expectancy is the most, let me rephrase this and just make this as easy to understand as possible. Expectancy in your plan is the most important number in your plan, period, full stop. Next, I would assume is frequency. Because if you have expectancy, but you have low frequency, you're not making any money. If you have expectancy with high frequency, now we're talking. Now we can do something here. Hey, there's another Texan here. What's going on, Texan T? Let's keep going. But I got to get back to the bingos. Over here.
The truth is, there are limitless approaches. The choice often depends on your personality and goals.
It's like this guy watches my channel. I watch his channel. He watches my channel. It's a whole channel symbiosis going on here, right? Talking about personality and trading. Your trading style, I can guarantee you, will not be the same as mine. And that is okay. You have to come up with the style that fits for your personality and your portfolio, right? Once you figure that out, it makes things so much easier. That really is the mindset button right there, which we already got. And you can't predict when your trades are going to come. So I'm going to give you that one right there.
Over the last 30 years or so of trying every strategy, time frame, and theory under the sun, I found the consolidation breakout strategy on the weekly time frame.
He said breakout. Oh no! Did he actually say breakout? Oh no! I'm so cooked because now I have to pull out the bullhorn I wasn't ready for. I don't know why I didn't have this ready. I'm so cooked because now I got to pull out the bullhorn because it's our very first bingo, baby! There we go. How are we high frequency with 9 trades in January? You can determine whatever your trading plan is. Mine seems to be working pretty damn well. I'm just saying. Let's keep going.
To be optimal. not only for return on risk but for my lifestyle. The weekly time frame is far more passive and aligned to my goals. We have a bespoke breakout scanner for finding the setups I look for, offering low-risk structure with the potential for high reward. You're more than welcome to use the links below, which also provides our free ebook of my entire approach. So to recap, for the majority of traders, it will be wise to keep your losses less than your reward. As soon as you develop asymmetrical risk, often through the need to be right, trading will be difficult and likely unprofitable. Try to develop an approach that allows for rewards to be a multiple of risk. High win rate alone is often a mirage and usually hides something more sinister within it. A system built to allow for failure is far easier to follow, whilst a
See y'all throwing stuff in the chat. Use a stop loss. Yes. I don't know if you said that exactly, but I'll give it to you. Who said that? Use a stop loss. Sheetal. Hey, Sheetal. I think, are you the Sheetal that I've been emailing with? Let's go.
system that is easier to follow allows for positive expectancy to feed through into your results over many trades. For more videos on expectancy, risk to reward, or my own strategy, check out.
This is really cool, right? Being able to see what expectancy looks like in real time. Now, you won't be able to see what expectancy looks like in real time unless you journal your trades, because there's no possible way that you'll be able to come up with a trading plan unless you know A, what you've traded, and B, how those trades went, and C, that's a second bingo, baby. Now listen, we are going to be giving away free products from our merch store, but only if you put in hashtag Masters of the Universe with a $, Masters of the Universe money. And the thing here is that if you don't put this in, you aren't going to win. If you have done it already, do it again. Less than half of you that are watching right now have put this in. So there's no excuse. Put it in. Put it in real quick, right quick. Yes, I am engagement baiting you. I don't know if your entry counted earlier. As you can see, it's rising right now. So there's a possibility your entry didn't count earlier. So that's why you need to throw it in the chat right now. Because we got 2 bingos on the board. How close are we to a third? How close are we to a third? How close are we to a third? What's the latest news? Did the president commander? Oh man, I'm telling you what, this looks so much like the market cycle. It's scary. So much like the market cycle. It's scary. Did Donald Trump say something? Did we get a Trump square? There's only one way that could have happened, and the Trump square means it's a automatic bingo. That's right. That's right. So we got 3 bingos on the board. Look at that. Look, the things I do for you. Now do for me, put hashtag Masters of the Universe money in the chat. First winner on the board. Who's going to be our first winner of the day? First of 3 winners on the day. Oh, there was me. I saw me. It's UB57, Frank. UB57. You're not 56. You're not 58. UB57, Frank. Frank, congratulations to you. Let's see what Frank has won. Let me start my email over here to April. Let's see what Frank has won. And if you turn out to be a winner like Frank, even though he's 57 today, he needs to email support@outlier.com. Say, hey, I'm UB57 Frank. Please give me my prize. My prize is coming from the merch Spin the Wheel. By the way, if an ad pops up, you don't win what's on the ad. You only win stuff from our merch store. Let's see what Frank's won. Frank has won, hopefully something warm. A slingshot mug. You know what he can put in a slingshot mug? He can put in a warm beverage of his choice. Where's that slingshot mug? Let's go over here real quick. Slingshot mug right there. Frank, congratulations. You won yourself a slingshot mug. Congratulations to you. Slingshot mug for Frank. Who's our second winner of the day? I don't know who the second winner is. Let's find out right now. Who's the second winner of the day? Who's the second winner of the day? The winner is, get some HEB Texas pecan. It's Mad Max, who I assume is from Wisconsin. Mad Max from Wisconsin. Congratulations, Mad Max. You are our second winner of the day. Let's see what the Mad Max has won. Mad Max has won. Let's see. Mad Max has won a $10 merch credit. Now, that may not sound like much, but as I mentioned before, everything in our merch shop is literally priced at the lowest you possibly can. So you could get a slingshot koozie or any other koozie, plus a slingshot mug or any other mug for roughly $10. Put in code OVTLYR at checkout, OVTLYR. You'll save 10%. You might just hit that $10 merch credit. So congratulations to you, Mad Max, $10 merch credit. And hold tight here. Got to work on my email on the other screen here. $10 merch credit. Final winner of the day. And of course, you still have a chance to put it in if you put hashtag Masters of the Universe money in 3, 2, 1. Let's go. Mad Max. I'm happy for you, dude. I'm glad you're here as well. Tell everybody you know about Outlier. Third winner of the day is Dublin Capital. What's going on? Dublin Capital has become one of our, what do I want to say? Dublin Capital has become a very frequent contributor, not only on the YouTube channel, but also in our Discord. Dublin Capital, congratulations to you for being a winner. Let's see what Dublin Capital's won. Let's see what Dublin Capital's won. Dublin Capital has won an 80 Delta shirt, sitting cash. Wait a minute. Oh, we've got a bit of a typo here, Rudes. Do you see this? Sitting cash and don't F up shirt, 80 Delta shirt. I don't know. How about we give Dublin Capital the choice between a Sit and Cash Don't F Up shirt or an 80 Delta shirt. And I will make sure that April and Cheryl knows your choice is choice between 80 Delta and Sit and Cash and Don't F Up shirts. Okay. Clearly a little glitch right there, but that's all right. As a professional YouTuber, we know how to work around those kind of things. Listen, if this has been useful at all to you, the best way that you can help me out is by sharing this with someone you know, right? Our goal at Outlier is to make you a successful trader for basically free, okay? Everything that we put out is 100% for free. All of our invitation-only live streams will be on YouTube the next day for free. You can see every single trade that I've taken linked down below. Absolutely no paywall, no email address, no nothing. Just click the link. You're right in the Google Doc. My entire trading plan that I showed you right here with the expectancy and whatnot, linked down below. There is nothing in your way other than clicking that yourself and becoming successful. Then when you are successful, our grand evil plan is for you to become an outlier at 82 cents a day. It's unbelievably inexpensive. So listen, if you're ready to save time, make money, and start winning with less risk, click one of these 2 videos and have a fantastic day. We'll talk soon.